If you've heard about dollar cost averaging and you're confused, you gotta watch this video. You should absolutely be doing this. In this video, we'll talk about this essential investing strategy and how you can apply it to your investing journey. According to Investopedia, dollar cost averaging is an investment strategy in which the investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. So what's all this mumbo jumbo mean? In essence, you're putting the same amount of money into your account every month and investing in the same asset regardless of what the market is doing. This way, you're not trying to time the market. Rather, you're being consistent with your investing process as the market goes up and down in value. And this is incredibly relevant at the time this video is being produced, as the market is completely tanking and you very well might be afraid that you're going to lose all your money. We'll talk about this a little later, but check this out. A recent national survey was conducted, and it turns out that almost 40% of investors pulled money out of the stock market over the last year, mostly due to the current events that are affecting us all. And many of them regretted this knee-jerk reaction.
Jeez, I'm an idiot.
But here's the crazy part. Looking back to data all the way to 1930, a recent research study found that if an investor missed the S&P 500's 10 best days each decade, the total return would be 28%, meaning that the investor pulled money out and was waiting for the best time to buy in. If, on the other hand, the investor just held strong through all the ups and downs, their overall return would be over 17,000%. When stocks plunge, it's a natural impulse to hit the sell button in a panic. But the study found that the market's best days often follow the biggest drops.
What?
So panic selling can significantly lower your returns by causing you to miss those great days. And if you're worried about seeing your retirement account balance go to zero and you're contemplating selling out, you are not alone. There are a lot of people sharing this fear. In fact, 70% of American investors allow the news and the current events to sway their investing strategy. Dollar cost averaging, maybe into an ETF like SPY or VOO, is the exact opposite of what those fearful wannabe investors are currently doing. This is a set it and forget it mentality.
Set it and forget it.
Set it and forget it.
You just set it and forget it.
Forget the news, disregard those scary stories, and just keep buying in.
Okay.
And in 30, 40 years, you'll have millions. Invest in the down markets and the booming markets. And in case you're confused, check out this graph. This is what the market looks like on average. Over time, it consistently goes up as the decades push on. However, this is what the price actually looks like. Your job is to buy, whether the prices are high and low. And in doing so, you'll average this consistent return over time. When the market cycles, stock prices in the S&P go up and down over long periods of time. The dot-com bubble, the housing market crash, the great market we've been experiencing for almost a decade, and now a potential recession on the horizon. During these highs and lows, it's proven that dollar cost averaging in is the best strategy. The hardest part is having the mindset to do this. It takes consistency, patience, and fortitude to continue doing the right thing, even in the face of impending doom. Here's the truth of the matter. It's nearly impossible to perfectly time the market, meaning getting your money in at the lowest point and expecting it to go up the very next day. Not even Warren Buffett, the greatest investor of all time, can time the market. You got to get out of the mentality that you'll be the one that can correctly time this market, because you won't. And trying to wait and invest at the very moment the market hits rock bottom.
Wait. Yeah, there we go. Wait.
Is going to deprive you of having that time in the market. And this, coupled with compounding interest, is what will really catapult your wealth. It's time in the market, not timing the market. So you may be asking yourself, why should I invest when the market's down? Shouldn't I be selling? Why should I be investing if the next 2 to 5 years are going to be really bad?
No, nothing about this adds up at all.
When you hear that your friends are selling out and cutting their losses, or buying into high-flying stocks and cryptos when everything's awesome,
Oh my gosh, I love this song.
you still have to stick to your process and dollar cost average in. This is proven time and time again to be the best strategy. Here's what it looks like. Say you listen to this video and you start investing when you're 27, and you robotically put in $5,000 a year until you're 65. The average market return for the S&P 500 over the past 140 years has been 9.9% return. Take a look at this graph of the Dow, the 30 biggest American companies, and looking back, wouldn't you have been glad that you stayed in during all these periods and kept buying in when it went down? Even amid all the terrible lows, like wars, presidential assassinations, the tragedy of 9/11, and even the housing crash of 2008, it continued to go up. And even now, those catastrophic events look like little blips on the radar. If you blindly and robotically just kept buying in, assuming that 10% return and 3.5% inflation, you would have over $2.3 million in retirement. All this from dollar cost averaging and consistently putting money in that account.
This guy is good.
However, say you think the next 4 years are going to be really bad and you delay this process. You wait to the age of 31 to start investing. You'll only amass a bit over $1.5 million, a difference of $800,000 in retirement savings. Those 4 years of waiting cost you over $750,000. Here are some actionable steps to remember for a lifetime. Number 1, be consistent. Make investing a monthly or quarterly priority, putting the same amount of money in every time. Number 2, stop looking at your account balance. It sounds counterintuitive, but really, just don't care.
I don't care.
Buy those low-cost index funds, ignore any recent results, and just know you're taking the correct steps to amass wealth over time. And number 3, bask in the glory of knowing you're doing the right thing and that you're a more informed investor than all the nudniks around you who are probably screwing this up. If you like this video and you're ready to take the next step, check out this video where I talk about opening a Roth IRA and how it can transform your retirement. The money you put in is after tax, meaning that the money grows and compounds tax-free.